Hello and welcome to this week's edition of MindWeb.com's Gold Weekly podcast. My name is Jeff Candy, and joining me on the line is David Morgan. He is the author of the Morgan Report. David, much has been written about the state of the global financial economy, about the fact that we are in a downturn at the moment. Clearly, there are a lot of problems within the commodity sector as a whole and with mining companies in particular. The big questions in my mind is, though, is this just another cycle, or is there something fundamentally different this time? We've heard a lot of people say that this time it's different, and generally speaking, people tend to say that each time there is a change in the cycle. But how true is it this time?
Great question. I think it's fundamentally different this time, and I want to stress the word fundamentally. If you look at the commodity cycle, if you look at Jim Rogers' book, you look at some of the other rather good students on the commodity cycle, you'll find that most commodity cycles last about 17 years. If you look at well-respected establishment situations such as, say, the Silver Institute, for an example, or maybe some of the Zinc Institute, you'll find that, again, that the mining cycle has this very huge business cycle. In other words, you get into an overproduction situation where there's, more than enough base metals being mined, and then there's people that can't make money at the margin, and they go out of business, put the mines on hold or whatever, and then you get into the slump. And these are very long-term cycles. So that fact, I think, remains. What's fundamentally different this time is that we have a global situation in the financial structure that's failing. It's failing before our eyes. It's all based on Keynesian economics. And in Keynesian economics, the idea is that government or the state can come in and mellow out the business cycle. There'll still be some ups and downs, but they can, with their power, manipulate the money supply, manipulate interest rates, save banks, and everything that we've seen go on for the last several years, basically really before the 2008 financial crisis, but particularly from that point forward. And it's not working. The idea that you can stimulate the economy with government intervention has worked up until about that point. And now it's not working. It's not working in the United States. It's not working globally. So what my call was going back into about the year 2000 was that things had shifted on a macro scale massively. Two things had shifted. One is that we're going from a paper asset-based stock market bubble, which was in 2000, to a commodity cycle. And the main shift that everyone can understand was we're going from things you want to things you need. Commodities are needed. You need to eat, you need to be clothed, and you need some kind of shelter. Excuse me. And this will continue. And so now what we're seeing is a breakdown of the system. The stimulus packages that have always worked in the past have failed. QE1, QE2, QE3, QE infinity, name it what you want. It's not just the Federal Reserve, which probably is the most powerful central bank in the world, but nonetheless the other central banks, the ECB example, are all not able to resurrect this model of prosperity by printing money. So that is the fundamental fact. So now back to the commodity cycle. So what does that mean? What it means is within the commodity cycle, you have to look absolutely at what is the most needed commodities. And in all honesty, being a metals head and having been one my entire life, basically, the most needed is food. I mean, food and water are really the most needed. So those are the two primary commodity sectors. But the whole system runs on energy, so that's probably the next one in line, or right up there. So that would be, of course, oil, natural gas, gasoline, that type of thing. And the fourth in line would be some way to preserve wealth that's been accumulated, or an asset, let's say a tangible, real asset that preserves what is now maybe in the realm of the ether, meaning what I call the matrix. You've got a pension fund, you've got some type of debt, which is what the whole problem is with the world banks all having these bonds. government or otherwise. We look at Detroit here recently, it's failed, and everyone's tied together. They're all interconnected. So as one domino goes, it hits 2, those hit 4, those hit 16, and on it goes. And this is the problem. It's systemic risk. So yes, fundamentally, we are in a position that has never, ever been tried before. We're in this massive Ponzi scheme. We're in this idea that we can print wealth, we can get out of it this way, that we can stimulate the economy, and it's plainly not working. So the commodity sector, I think, will be one that has to continue to increase in value because they're needed. But within that sector, within the commodity sector, I think you want to be selective of what I just outlined. What are the most needed commodities? And obviously, there are some that are needed more than others.
David, how does that tie into then the whole mining space? Because while there's very much and the reasoning behind the need for commodities is sound, but the big problem is that the mines still run on money, in that they need money, they need financing to finance drills, to pay for salaries, etc., before they can start digging stuff out of the ground. And so there does seem to be a dislocation almost between the commodity side of things and the companies that are pulling those commodities out of the ground.
Excellent, Jeff. Yes. Right now, we just finished a study in the Morgan Report, and we're continuing, in fact, to look at particularly the precious metals, because that's what we specialize in. But it would apply across the board for the mining industry. And that is, what is the margin? In other words, every business out there, if they're real, has to make a profit. Otherwise, you're not in business. Right now, the true cost of mining silver for a primary silver mine, I'm not talking a byproduct like, let's say BHP or Rio Tinto, is around a little over $20 an ounce. So a lot of these mines now are at the margin. And so what it means is, as you say, if we continue to be in a situation, let me back up, gold is around the $1,400 level. So right now we're in a position for both the precious metals where a lot of these mines are right at the margin. So if this slump continues much longer, these mines will be forced to either cut back, curtail, go on minimum maintenance, and that type of thing. And I want to point out something, because I've been in the industry a long time. I used to always think, previously to learning more, that if you were losing money on a mining project, well, it would be simply a case of a few months and you would shut down the mine. And what I learned from the industry is that that's not necessarily the case. And the reason being is that there is so much need to keep a mine working, even at a loss, because it's a lot cheaper in the long run to work months and months at a loss rather than shut it down. Because once you go on care and maintenance, it's extremely expensive to bring the mine back online. So I think what it means is this, Jeff, I'll get right to the point. I think it means that the base metals are not going to be as needed in the future as they are right now. Honestly, this is probably going to upset some of our listeners, but gold is not really needed as much as silver is needed. I mean, silver is needed, obviously. Anyone that's listened to your show or any of them knows that silver is needed in the high-tech society. Nonetheless, I think you're going to see a separation there. I think you're going to see these marginal mines that are out there have to question whether or not they're going to stay viable or not. For the junior sector, it's a rather horrendous situation. Unless they have an asset that's so outlandishly awesome that can be, an M&A situation, a merger or acquisition. In other words, it's an asset that's so juicy that a larger mining company will buy it because they're getting it for pennies on the dollar, and that will happen, but there aren't many left. The rest of them basically go on the wayside. I mean, this is a number, it's the idea, no one knows the amount, but it's the idea that I want to get across. And that is, I've heard in Vancouver, where I recently, did another speech, that one of the more connected people, will say, in the junior mining space told me that he thought that about 50% of the juniors, now it depends how you define juniors, but I'm going to refer to it as exploration companies, are probably going to go by and by. They will be gone. They will not be able to maintain their companies because they have so little money in the treasury, they're not able to raise funds. So I hope I'm being succinct now, and that is that a lot of these companies will fail. A lot of the mid-tiers, if they have margins, will continue, and the ones that are marginal, depending on their size, will be able to continue or not. Depends how well they are connected to the financial industry. For an example, let's take a large company. I'm not going to name one, but pick one. And if it's right at the margin, if they're well connected to the banking system, then certainly they're going to be able to get quote unquote bailed out or be able to raise capital or issue another bond or a debenture or a gold-backed security or who knows what to continue operations. But if you're kind of in the middle, and you're not really well connected to the banking structure, or you're below that, and you don't have enough money to continue operations now, and you're an investor, especially as an investor, and you look at those companies, I think you got to take a big dose of reality and figure out that, wow, maybe I better reallocate my investment. Having said all that, let me take a deep breath and go on. The ones that do survive when the cycle turns, and I don't think we're that far away, the ones that will survive have got massive leverage to the upside. I mean, massive leverage to the upside, because once the ship is sinking as it is, and more people recognize that and start to bail off the ship and get into the lifeboats, you're going to see more and more people come into the sector. So the few remaining, or whatever is remaining, are very small. It's like the Titanic analogy. There's a lot of people that want to get in a lifeboat, but there aren't enough lifeboats. So they're going to be bailing into these things like crazy all of a sudden. It could take off very rapidly. And there's going to be a massive amount of money trying to chase into these companies. So it's bad right now. You could say the word bad, or it's been very trying for commodities investors. But yet the situation is such that it's actually going to be so massively leveraged to the upside in the next several months to several years. I think it's going to take place starting probably by the end of the year. I think we'll settle out by then. And then the next few years, I think it's going to be massively important to be in this sector.
David, given the unprecedented nature of a lot of the things that you've been talking about, one gets the sense that everything that's been happening over the last few years has taken a little bit longer than people were expecting. The ups have been a little longer, the downs have been a little longer, and everything in between as well. When we started this year, there were a lot of people positive that 2013 was going to be different. We were going to see an uptick in all sorts of things. There was a lot of positivity around silver, particularly. That's clearly gone by the wayside to some extent. Now, what's likely to change that sentiment? Then, how do you think this turn is going to come?
Yeah. You gave hard questions. Well, you're right. What's interesting is what you said is true. I do recall early in the year how many people were so bullish on silver. And I said, and you can go back and check the record, I said this would be a transition year. So first of all, you're right. In fact, there were a couple of ideas for silver-only summits, which is rare because silver is a very small market. And to have a silver-only summit like we do in Spokane every year is tough because there's not a lot of interest in silver. There's far more interest in gold than there is in silver. Anyway, both those were canceled. And so going to what I said this would be a transition year. What I mean is that this would be the year that, going back to the analogy I just gave, that more and more people are realizing the Titanic is sinking and they have to find a lifeboat. That's the transition. It's that point in time where you're on this system that can't fail, it can't go down. All the propagandists at all levels throughout all the states, in other words, the nation states around the globe, all the banking elites are all telling you, everything is fine, listen to the music, there's nothing wrong here, we have it all under control. And as everyone thinks that that's the case, there's a few that are looking and seeing the ship is going down. So they're starting to edge toward the end of the deck to get on a boat or lifeboat. And so that's the transition that I'm talking about. This is that year in my view. What that means is to prove that I'm right, it doesn't have to be this year. I don't want to, hedge my bet too much. I like to be a straight shooter, but no one knows the timing on this stuff. That by the end of this year, I fully expect we'll see silver and gold up over these crash levels. So silver will be up over the $26 level, and gold will be up over the 1550 level. That's about the best I expect right now. And, I get criticism as, anyone in my position criticized heavily, and that's fine, and it goes with the territory. But they say, well, David, you said that silver would be at this price, whatever. This was the reason you get the Morgan report, because as conditions change, the outlook changes.
Things change.
And I did, I give a philosophical statement. It's going to be a transition year. I didn't know, exactly how, but that's still a very strong opinion of mine. I do believe I'm correct. Time will tell. But this is the idea that by the end of this year, maybe not everyone's going to be diving into the lifeboats, but there'll be a lot more people that will be edging toward the deck wanting to find one. And you know what? They're going to look in the water and see a lot of them already full, and they're moving away from the shipwreck. And they're saying, oh man, and then it's going to start to accelerate. And again, no one knows when that will take place. And that's why I love this saying, I'd rather be, 6 months too early than 6 minutes too late. Because once you look and there's that last lifeboat, it only holds 35 people and there's 350 that want to get on it, then what do you do?
You make a very good point, and you mentioned earlier that silver is likely to perhaps do better given its use in industry and as a needed metal, as you say. That being said, though, if we do see this change, this realization, perhaps a collapse in some parts of the system, or just in general in terms of how the monetary system works, is silver then straddles two things that seem in my mind to be almost mutually exclusive, the monetary side to some extent and the economic growth side of things at the other. Is that a false assumption on my part?
No, it's spot on. But what people don't do, in my view, is analyze it correctly. If it's, let's just say let's just look at the extremes. I mean, this is like doing integral calculus, and I'm not trying to impress anybody, but I got a strong math background. So let's look at the extremes. Let's say it's only an industrial metal. If it's 100% industrial metal, which of course isn't true, but let's say it is, then as industry declines, it's not needed because we're in this global depression, and all you are going to do with your money, your currency, is you're going to buy food, water, and housing and clothing. That's it. You don't have anything left at the margin. You have no available funds to invest. You have no capital to preserve. You're hand to mouth, okay? So in that extreme, what happens? Well, what happens is at the absolute, I'm talking philosophically here, there is no industrial need for silver. So there isn't any mining for it. In other words, it wouldn't close all mines, but in theory it would. In other words, if there's no demand for something, and if there's no demand, there's no market. So if it's industrial only, then it will wane. It will go down substantially. And that's part of the case. And I'm making somewhat that case, somewhat, not 100%. So let's look on the other side of it. It's 100% a monetary asset. Okay, well, there's an infinite amount of demand for money. It's a nonstop thing. Most people that are normal have a certain amount of money that they need, and then on top of that, a little bit more that they want for retirement, disposable income, as we refer to it in the United States. But there is an infinite demand. So that goes into the equation. What is the demand for money? It's infinite. Now, you have to define what money is. And of course, I've spent, way too much breath on that topic. But I mean, you can have a currency or you can have money. You can either have something with someone's picture on it on a piece of paper, or more specifically electronically, anywhere in the globe, or you can have something that represents money for over thousands of years. And that fact is something that goes through about 99.27% of the population. Less than 1% of the world's population even gets that idea. So when another 1%, when those, that other group goes to the edge of the deck and looks into the lifeboats and realizes, oh, that's it, and realizes that, this is the only asset that's outside that can get me off of this ship that's sinking. Those papers can't. All this financial system has been a big hoax. Then you're going to see a spillover. So if it's only money, the demand is infinite. But the reality is it's both, as you said, and there'll be some industrial demand no matter what, no matter how bad the global economy gets. But there's an infinite demand on the monetary side. So that's what will take silver far higher. And the reason it'll go, I think, well beyond gold on a ratio basis is because, again, it's the poor man's gold. So once gold gets into the 2,000s, 2,500, 3,000s, I don't know the number and its individual basis, but it'll get so high that most people say, oh, man, I missed the gold bottom. I could have bought it at under 1,400, and I wished I had. But now it's 2,400. Silver's only 52. I'm going to buy silver instead. And that's what's going to happen, in my view. That's what happened last time in the 1979, 1980 run up, the acceleration of the market. I think it'll happen again, except this time it'll be a global phenomena. It's the whole world that's going to be looking for those lifeboats this time. It's not going to be just the United States looking at, the fiscal problems that were evident in the late 70s with high inflation. This time it's going to be a world currency crisis.
David, very quickly to close off with then, how do you see the currency side of things falling out? I mean, clearly it's almost an impossible question to answer, but do you see gold and silver playing a significant monetary role in terms of functional use, or is it more on the sides as a store of wealth?
I think at this point it's probably a store of wealth. I do believe that the powers that be will be able to come up with a solution. I put that word in quotation marks, and probably do some kind of fiscal chemistry and come up with some idea that you could have some kind of digital gold-based system or something along those lines. It's hard to say, but certainly these bankers, I mean, they are not, they're very smart.
Nothing if not innovative.
Yes, right. They could innovate anything, especially in an electronic digital world. I mean, they could say, well, we have this much gold. We've been buying gold over the last time, over, X number of years. And I mean, there's so many options that they have, and people don't think it through. I mean, they would be, many people would say, oh, wow, finally relief. There we are. Okay, now my debit card, when I swipe it, it's taking off so many grams of gold, and, the system is great. And it's based on confidence. I mean, if you can con people into the idea that, it's gold backed, even if it wasn't, you could probably produce stability in the system again.
David Morgan is the author of The Morgan Report. And that's it for this MindWeb.com Gold Weekly podcast. From me, Jeff Candy, thanks for listening. And please join us again next week.